Good afternoon, everyone. Today's Monday, the 9th of January, 2012. Let's take a look at this market here. We had a quiet session, real light volume, and the market basically went nowhere as far as the S&P went. Well, it was up 31 cents, but we do remain above key levels here for the SPY. We are, of course, above that 200-day moving average and that little downtrend line we'd been monitoring, which I didn't just draw properly, but this was really the essence of the trend we were measuring. And of course, we have this one that it broke as well, and we have one more trend line that should be hit near about 131 if the market can make it up towards that level. But of course, we have a prior level of importance near about 130 to 131. So that's where it looks like there's the bigger potential for resistance if this market can continue to move higher. Looking at the 30-minute time frame, we can see we've been riding this rising 5-day moving average, and what we've been talking about is the higher low that we put in last week. That if we can remain above this higher low from last week, then the intermediate term should be considered innocent until proven guilty. Now, it doesn't mean that we might not that we might break this trend line and turn sideways and correct back down towards 126 and a half. That's obviously a possibility. But if we get below that 5-day moving average and we begin to break this low at about 127 and a quarter, then it looks like 126 and a half would be next. So that's something to be aware of. I don't think that it would be a disastrous event because, again, we have that rising 10-day moving average above the rising 20, above the 50-day moving average, and we have this bigger prior level of resistance. We did start earnings season today. Alcoa reported after the close, and a lot of people make a big deal about Alcoa because it's basically unchanged right now, and mainly because they're the first company to report. As far as its importance to the overall market, it's really maybe I'm missing something here, but I don't see why there's so much significance is given to it beyond being the first company to report. So people will forget quickly about Alcoa and focus on more important things like the average of 500 stocks, the S&P 500, showing us much better performance, obviously, than Alcoa has over the last year to 2 years. Anyways, what we want to look for here is, we've got this tight consolidation, 128 and a quarter, basically. We can get above that, then it should be able to make another push higher, it appears. And where that might end up is possibly the highs from late October 1st. And first level is the highs from October, not from October 1st, the date that is. But right around that 129 and a quarter level looks like the first potential target, then 130 to 131. So as long as we remain above really 127 and a quarter, I think you do give it the benefit of the doubt to the buyers. And the Nasdaq was down slightly today, down 19 cents or about a third of a percent. This market, as we know, has outperformed year to date. As it gapped higher and was pretty much higher every day last week, broke beyond that 57 and a half level. I wouldn't be surprised or concerned if it got a little bit below 56 and a half. One thing to be aware of, though, is a couple of the big stocks like Google. Google had a real nice breakout here about 2 weeks ago, and past that 638 level, and it's come down real hard the last 3 days. So this is looking like it has the potential to be, from a failed move comes a fast move lower. So be really careful with when you're looking at the overall trend. It should hopefully hold in here. The other thing I would say is, Apple went out to an all-time high today and then began to come back and close near the lows of the day. When it makes an all-time high after already having a large run like it has here. It's just run 10% from 380 up to 420, more than 10%. Those aren't generally the best places to buy a new high. We want to see them consolidate under there and then move higher. So Apple looks like it should probably consolidate a little bit at least, and I think that the Nasdaq is likely to do that as well. We still have a real nice pattern of higher highs and higher lows on that 30-minute, and you can see it on the 10-minute time frame. Although this could be our first lower high if we break below this first level of what's been important, short-term important, about 57.40. Then we're going to break. Well, that's where we should meet the 5-day moving average tomorrow. But below that, the bigger, more important level is, of course, that $56.50 level, basically, and then 56 below that. But breaking below here, we want to be aware that maybe it's going to indicate a little bit further profit taking before this market can continue to move higher. You can't just get excited about this little high break. We need to digest this gain, and a little further pullback would be healthy for the Nasdaq. The Russell 2000 was up 0.5% today. Nothing really going on in here, but we're getting a tightening of range, and that's good to see. That tightening of range is occurring just below that 200-day moving average, and we've also been focused on this prior high at about 76.5, and just up above we have that 77.5, which was important support last year. So it's difficult to make the case for a large breakout in the Russell 2000, but it is looking more neutral at least, and holding on to the gains. It would really to become bearish. I think you'd have to see it below last week's low, near about $73 a share. So intermediate term, as long as we remain really probably above 73 and a quarter, innocent till proven guilty, but still got some choppy action in here, but back above these recent highs at 75.45, that could be the basis of it getting moving higher up towards that 200-day moving average initially at 76.20. So it's not a big distance away, and if it was to make it up to there, I think that the 76.5 level would be likely as well. One area of outperformance today was the semiconductors. They were up 1.6%. And by the way, it's Monday, and that means that this video is brought to you by Realtik. Realtik is a trading platform that I've been using for years to trade on, and check them out at realtik.com. That's what these charts are. That's there's just a ton of tools on Realtik that you can use to supplement your analysis and become a better trader. But the semiconductors broke this downtrend line. It's headed for the 200-day moving average, and as we know, last week we were talking about the 3150 level. So we got above that 3150 level. Let's see if it can hold now. We made that break of that area. Initially, we want to see 3150 to about 3130. This is the level, the band of support we want to see hold if we get a little bit of profit taking the next few days. So that's our important level. Otherwise, it looks like it's continuing up towards that 200-day moving average. The 200-day moving average is just above at 31.95, so it's not that far off. The financials were up a 0.5% today as well. We know about this longer-term trend line from the highs last year that kind of ties in near that 200-day moving average up at $14 a share, and this prior level where we found some resistance late or mid third quarter at about that 1420 level. So 14 to 1420 still looks like or reasonable in here. I shouldn't say likely, because you look at this daily time frame, it's still kind of a mess, but we're showing that we do have these higher highs and higher lows. So again, the important level for the financials will be last week's low, down near about 13 and a dime. Maintaining above that, then we basically give the intermediate term the innocent till proven guilty label. And really, if we can break the highs of last week, then perhaps we get a little bit further push up towards 1370 and then that $14 level. So still a lot of mixed messages from the market, and we have earnings season starting. So make sure that when you're trading stocks and deciding whether to hold them overnight or not, that either that company or one of their strong competitors might be reporting earnings, because it could either, it's a crap shot. It could either send your stock significantly lower, or maybe you get lucky and it moves higher, but you want to mitigate risk in front of those earnings reports for sure.